Hi everyone and happy Monday. I hope everyone had a relaxing weekend because we are headed into a week full of interesting earnings and central bank decisions. Oracle and Broadcom are due to release their latest earnings this week on Wednesday and on Thursday respectively, while the Federal Reserve in the US is fully expected to cut the interest rates on Wednesday. Then the Reserve Bank of Australia, the Bank of Canada, and the Swiss National Bank will also be announcing their own decisions this week, and they're expected to make no changes. But there is no guarantee whatsoever that the Fed cut this week will provide investors with a Christmassy joy, because any hawkish comments from there could rapidly sour the market mood and eventually limit the yuan gains. So welcome, this is Monday, December 8th. You are watching Swissquote's Daily Market Talk. I'm İpek Özkardeşkaya, and everything that I will say in this video are based on my own opinions, and this is not financial advice. So last week was full of uncertainties and mixed feelings, remember, but the US indices still ended the week on a positive note after the PCE data, the Fed's favorite gauge of inflation, confirmed on Friday that inflation in the US remains high, close to 3% level, which is well above the Fed's 2% official inflation target, but steady. Core inflation even eased to 2.8% from 2.9% a month earlier, and the data is up to date. But more importantly, for sentiment, the Michigan's 1 and 5-year inflation expectations both fell. December survey printed a certain improvement in consumer sentiment, certainly because it's soon Christmas, but the current conditions deteriorated. And a notable deterioration in the latest economic data in the US explains why inflation expectations are being pulled lower right now. The weaker the jobs market in the US, the more worried American people will be to spend their money, and the less they spend, well, the slower the price pressures. That's obviously not great news for the people in the main street, but it's certainly great news for folks in the Wall Street, for those who can't wait for the Fed to lower the interest rates, while the company earnings, especially for the S&P 500 companies, remain somehow robust. So the good news is that the Fed will announce that 25 basis point cut on Wednesday unless aliens invade the world or something really big happens. The weakness in the recent jobs data and stable and up-to-date PCE print back that decision. But what happens next is the part that no one can agree on. Because the FOMC is divided, some members continue to worry that the tariff-led inflation could counter potential disinflation and require a careful approach next year compared to just cut the interest rates and see what happens, because this is what Americans want anyway. So the base case scenario is that the politics will outweigh next year and that the Fed will continue to push for lower rates, as the committee will be replaced by members that will be backed by Trump, and they will back Trump's low rate ambitions in return, starting with the new Fed chair that's going to be announced in a few days probably. But the bad news is that if the Fed backs political ambitions in the absence of economic justification, the rate cuts from the Fed next year could backfire and yields could rise eventually. Because otherwise it would be simply too simple. Every central bank would just cut the interest rates and keep investors and people happy. That's not how it works, unfortunately. Central banks have the tough job of balancing out employment and inflation. They're moving in opposite directions, and when they're not acting to do that, to balance that fine equilibrium out, well, investors could fight the Fed. So what I'm trying to say is, I'm not trying to say fight the Fed, but I'm trying to say that this week's Fed cut may be a done deal, but the reaction and the outlook are not, and the Fed decision could eventually disappoint if the Fed outlook remains this uncertain. Elsewhere, the Reserve Bank of Australia, the Bank of Canada, and the Swiss National Bank here in Switzerland are expected to maintain their policy rates unchanged at their December decision. For Japan, though, today's ugly GDP print somehow put the Bank of Japan hawks in doubt about the next week's coming decision, but the 10-year yield kept pushing higher, now at 1.96% level, as wages growth in Japan accelerated and maintains inflation worries alive. So the Bank of Japan will likely hike the interest rates when it meets next week than otherwise. And before we move on, tensions between China and Japan are rising, pushing the Japanese defense stocks up, with Mitsubishi and Kawasaki's heavy industries, for example, gaining between 2 and 3% at the time I am talking here this morning. The Chinese stocks, on the other hand, are up as well, but they're up on great trade data that show that exports from China printed a decent jump last month as firms in China rushed to move their inventory to take advantage of a fresh tariff truce with the United States. So US crude that surged past the 50-day moving average last Friday and closed last week above this level is upbeat this morning, hinting that a further rise is now plausible, backed by a softer US dollar that, in theory, should increase appetite from EM countries and bag oil prices along with the AI demand. So speaking of AI, 2 AI plays are due to announce their earnings this week, and it's going to be very interesting. Now I will start with the easier bite, which is Broadcom. Broadcom will be announcing its earnings on Thursday, and things should eventually go well. That's the expectation, because the company will be benefiting from the Google's TPU sales, as Google is now deploying its TPUs at large scale, both internally and for customers outside Google via Google Cloud, and Broadcom is one of Google's key partners in producing these chips, handling physical design and components for the latest TPU generations. Also, remember that this company also recently agreed to sell its chips to Meta, so that could be a huge revenue opportunity. So the rising demand for TPUs will translate into sales revenue for Broadcom, or at least into a very strong guidance, a thing that sure explains why the company's stock price has been, for now, resistant to the latest AI worries. Oracle, on the other hand, is another story. It's a little bit more complicated there. The company is now considered as the bellwether of AI risk, because it has taken massive debt on its shoulders to invest in AI projects, and it also carries a lower credit rating than other big technology names like Microsoft or Amazon, for example. Its 5-year CDS spiked last week to a 16-year high, showing how investors are getting a bit stressed about all this debt story in AI. So for Oracle, it is complicated, as I said. Analysts expect Oracle to deliver about $16.2 billion in revenue and $1.63 in earnings per share, which looks solid at first glance, but actually implies a moderation from the turbocharged growth seen in recent quarters. For context, Oracle's cloud engine has been firing hard recently. Total cloud revenue recently grew around 28% year over year, and OCI, which is its infrastructure cloud, surged more than 50% year over year. So these are huge numbers. Yet, overall company revenue grew closer to 12% only, reflecting its ongoing shift from legacy software to cloud. So the upcoming expectations translate to roughly 9 to 10% revenue growth and around 11 to 12% EPS growth for Oracle versus last year, signaling that Wall Street is no longer pricing in another blowout quarter for Oracle, but rather a continued and steady climb as Oracle converts its massive AI cloud backdrop into actual revenue. Good news is that expectations are low, and low expectations are easier to beat. But the bad news is that investors will be very picky about the ROI and the debt levels, because Oracle's massive cloud and AI build-out have come with equally massive spending, financed by debt, and that's where the key risks sit. The company is pouring billions of dollars into the new data center capacity, pushing its capex sharply higher and putting pressure on margins just as expectations rise. And at the same time, Oracle's debt load is one of the largest among the big technology companies, and the recent stress in its credit default swaps shows that markets and investors out there are increasingly sensitive to how much leverage is being used to finance all of these massive AI ambitions. From a stock price perspective, the company's stock price erased all gains that were accumulated after the announcement of massive deals with other AI companies, the circle including OpenAI. So the concern is straightforward. If Oracle's cloud backlog conversion slows or margins disappoint, heavy spending plus high debt could squeeze cash flow at precisely the wrong moment. In other words, the bull case rests on flawless execution, because the balance sheet leaves very little room for error. So it's going to be a very important moment for AI. That's going to be on Wednesday. But this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.